as the mushrooms run down the line, finish their screening, and then ship off to distribution sites across the Yangtze River Delta region. The day's orders are complete. Every day, this 25-employee company sells between 3 and 5 tons of them. That brings in around 10 million yuan a year. But there are a lot of costs, and the government and government-backed loans from banks are helping the company a lot.
The interest rate has dropped from 7.6% to 4.35% during the past 10 years, and the government's allowances can help us save another 50 or 90% on the interest.
With that financial support, Wang was able to open a new production base in Yunnan in 2019, 10 times the size of the one in Shanghai. And beginning last March, a more innovative financial service has become available. It's called supply chain finance.
Before, it could take a month to get our payment, usually more than 1 million yuan a month. But through the new system, I can get payment within around a week. Agriculture firms have very huge investments with low profits, so it's important to get the money back quickly.
So far, the Bank of Shanghai has already provided 8.8 billion yuan worth of loans to some 700 small suppliers of Dingdong Maicai, like Wang's firm.
Those companies cooperate with us, so we know they have orders. And according to the record of order volume with us, they can get a guarantee so that they can get faster payments.
Just last week, the Bank of Shanghai signed a new agreement with the firm to provide more targeted financial services to those small and micro-sized suppliers. At the beginning of the program, much of the loan's interest payments came from the fresh food vendor so as to attract more small suppliers to join. But under the new agreement, the bank has already selected a batch of qualified small and micro-sized companies based on their previous operational data, and they can get bigger loans faster. It makes things easier for the banks too.
Traditionally, when issuing loans, banks require some paperwork, including financial reports. But from a practical perspective, that's not that useful when assessing risks. But large core companies help us to reach out to small upstream and downstream firms so that we can get more accurate data, which reflects the operating condition of the small firms. Moreover, the large core companies have strong credit spillover, and that means we have lower costs in acquiring customers and lower risks, so the interest rate for the small firms' loans can also be lower.
With the accelerated development of those innovative financial services, including online insurance and digital credit, China has seen expanded coverage and more targeted provision of inclusive loans. Last year, inclusive loans to small and micro businesses provided by China's 5 largest banks increased more than 41%. And some local banks are also lending a big helping hand. Last year, the Bank of Shanghai provided more than 60% more inclusive loans than it had a year ago. Most of the small and micro-sized firms applying for inclusive loans were production-oriented or industrial companies. And the bank now aims to develop even newer ways to issue more loans to help support the small firms.
The data we've collected from 3 kinds of loans helps us build a model to judge the production and operational reputation of the small firms. This modeling is something traditional banks have always been short of, and that is what makes us more confident in judging small firms' production and operating conditions, and judge how they will develop. This has laid a solid foundation for a new kind of credit loan to become the future of small and micro business loans.
A decision made last week at the 24th meeting of the Central Committee of the Chinese Communist Party on deepening overall reform has given this market a further shot in the arm. It confirmed projects to promote financial inclusion efforts to better meet diverse financial needs in the economy. Zhang Shixuan Money Talks.